Writing in 1973, Americans believed the future looked unstoppable. Stocks were soaring, big corporations looked untouchable, and investors thought the market could only move in one direction, up. But then, almost overnight, everything came crashing down. The stock market lost nearly half its value. Millions of investors panicked, famous companies collapsed, and one global crisis changed the economy forever. This wasn't just another market dip. It became one of the worst financial disasters of the 20th century. So, what actually caused the 1973 stock market crash? And why does it still matter today? To understand the crash, you first have to understand the mindset before it happened. Throughout the 1950s and 1960s, the United States experienced massive economic growth. Factories expanded, consumer spending exploded, the middle class grew rapidly, and the stock market reflected that optimism. Investors began believing that America's biggest corporations were basically unstoppable. Companies like IBM, Coca-Cola, Xerox, and Polaroid became market legends. These stocks became known as the Nifty 50. People believed you could buy them at any price and hold them forever. That confidence became dangerous, because when investors stopped worrying about risk, bubbles began to form, and by the early 1970s, stock prices had become heavily overvalued. But the market kept climbing anyway, until the global economy suddenly changed. In October 1973, war erupted in the Middle East. It was called the Yom Kippur War. The United States backed Israel during the conflict, and in response, several Arab oil-producing nations retaliated. They cut oil exports to America and its allies. This became known as the 1973 oil embargo, and it shocked the entire world economy. Oil prices skyrocketed almost overnight. Gasoline suddenly became expensive. Transportation costs surged. Factories became far more costly to operate. And inflation spiraled out of control. Americans waited in massive lines just to buy gas. Some gas stations literally ran out of fuel. The modern economy depended on cheap energy. And suddenly, that cheap energy disappeared. Businesses slowed down. Consumers spent less money. Fear spread across financial markets. And investors realized something terrifying. Economic growth was no longer guaranteed. Once panic entered the market, everything started falling apart fast. From 1973 to 1974, the Dow Jones Industrial Average dropped by roughly 45%. Nearly half the market was wiped out. Some famous stocks lost 60, even 70% of their value. Investors who once believed stocks were safe forever suddenly watched their wealth disappear. And the psychological damage was enormous. Because market crashes aren't just about money. They destroy confidence. People stop trusting the market. Businesses stop investing. And that creates a dangerous economic cycle. But oil prices weren't the only problem. America was already struggling with rising inflation before the crisis even began. Government spending had surged during the Vietnam War. At the same time, the U.S. dollar was weakening. Then another major shock hit investors: political chaos. During the crash, America was also dealing with the Watergate scandal. President Richard Nixon became tied to one of the biggest political scandals in U.S. history. Public trust collapsed, and investors became even more uncertain about the future. And uncertainty is poison for financial markets. Because markets can handle bad news, but they hate confusion. When people don't know what happens next, they panic. By 1974, Nixon resigned from office, and the country entered one of the darkest economic periods in decades. High inflation, weak economic growth, rising unemployment, falling markets. This toxic combination became known as stagflation, and at the time, economists didn't even know how to fix it properly. Most market crashes happen because investors become too greedy. But the 1973 crash was different. This time, the entire global system was under pressure. Energy prices exploded, inflation spiraled out of control, political trust collapsed, and economic growth slowed at the same time. It exposed a painful truth about markets: even the strongest economies are fragile. And it shattered the myth that certain stocks were too big to fail. The Nifty 50 companies had been treated almost like guaranteed money machines, but during the crash, even great companies got crushed. And that lesson still matters today. Because every generation eventually starts believing This time is different. And every bubble eventually reminds people, risk never disappears. The damage lasted for years. Many investors abandoned the stock market completely. Some became afraid of investing forever. The US economy struggled throughout the 1970s with inflation and slow growth. Interest rates later skyrocketed as the government tried to control inflation. And trust in financial systems weakened around the world. But eventually, the market recovered. It always does over long periods of time. New industries emerged, technology advanced, and future bull markets created even bigger fortunes. But the 1973 crash left behind a permanent warning. Markets are driven by psychology just as much as economics. When confidence disappears, even giant financial systems can fall apart surprisingly fast. The 1973 stock market crash wasn't caused by one single event. It was the result of greed, overconfidence, political instability, inflation, and global crisis all colliding at once. And that's what makes financial crashes so dangerous. They usually seem obvious only after they happen. Before the collapse, everything feels normal, sometimes even unstoppable, until suddenly, it isn't. And maybe that's the biggest lesson markets keep teaching again and again. The line between economic confidence and financial panic is much thinner than people think.